dollar rallied for an eighth straight week last week, the dollar index extending its best weekly run since 2014 as equities softened just a little bit, with sentiment continuing to remain pretty fragile, especially given developments in China and amid a sell-off at the front end of the Treasury curve, with the 2-year touching 5% once more as we moved into the weekend. A huge couple of weeks now awaits the financial markets. This week, it's eyes on the US inflation data, the latest ECB decision, and a bit of a data deluge from here in the UK. But let's not forget next week, it's worth paying attention to already and putting it on the radar. 6 G10 central bank decisions next week, including those from the Fed, the Bank of England, and the Bank of Japan. Plenty for myself and Ryan Littlestone to discuss in the trade-off this week. So without further ado, let's get into the show. So, a busy show this week. Let's bring in my co-host, Ryan Littlestone from Forex Flow Live and Forex Analytics. A couple of changes on the show this week. We've finally managed to rebrand from Twitter to X. And also, I've got a haircut, rather drastic. And what I did at the weekend, Ryan, I actually took a picture of you in and said, if they could make me look like that, I'd be a chuffed man as I walked out the shop.
Oh, it doesn't matter what you do. You can't be as good looking as me, mate. You know.
Good comeback. Good weekend, mate.
Yeah, not too bad. It didn't last very long. Sunday, we had a load of fireworks going off, as we're going to talk about in the show. So, yeah, lots to get stuck into. And we said last week, the end of summer. Well, it's certainly the end of summer with a bang at the moment.
Yeah, absolutely. I was going to use a really awful pun there and say, you know, the summer weather's coming to an end and summer markets are coming to an end as well. So why don't we get into that with that little segue into Topical Thunder? So, although Ryan brought it up there, I'm going to delve into it a little bit more detail. The Bank of Japan, obviously, the big headline over the weekend, the yen, the big mover at the start of the week. An interesting one, really, given that when this interview was released, it seemed to go a little bit under the radar, and then obviously gained a little bit more traction when the yen popped 0.7% at the Asia Open, and then extended those gains to about 1% through early APAC trade on Monday morning. Now, the move in the yen all comes from an interview that Bank of Japan Governor Ueda gave in the Japanese press over the weekend, which was, and I'm keen to get your views on this in a second, Ryan, a little bit more hawkish, I would say, than what we've seen recently. And I think the key line that everyone is latching onto is the possibility raised by Ueda that the Bank of Japan may have enough data to end the negative interest rate program by the end of the year. And when he's talking about data there, he's talking about inflation remaining above target on a sustained basis. And he's also talking about earnings and wage rises keeping up with that. Now, on its own, that would be pretty hawkish and a bit of a turn in the rhetoric that we've had from the Bank of Japan. But when you read the article itself, rather than just looking at the Bloomberg or Reuters headlines from it, it is probably as caveated as you would expect from the Bank of Japan and from a cautious governor of the institution, who also in the piece repeated that they're going to be patient, maintain their easing stance, that the achievement of their target is, and I quote here, not in sight just yet. So I do wonder whether the market's gone a little bit too far, too fast on this. In terms of that reaction, as I said, the yen over 1% firmer, the 10-year JGB yield touching 70 basis points for the first time since 2014. And if you look at the rates market in Japan, the OIS curve now prices in a full 10 basis point hike. 10 basis points is tiny, but it prices one in by the end of the year nonetheless. The key thing for me, Ryan, and as I said, I'm keen to get your thoughts on this, is one, has the market overreacted to this? And two, is that it doesn't really seem like the BOJ's talk matches up with their actions, because as soon as the 10-year JGB hits 70 bips, they've come out and said, oh, we're going to send some loans to banks, we're going to increase liquidity, we're going to try and curb yield. So if this is the hawkish pivot that everyone's been expecting, why on earth are they trying to do that? Because having the whole having your cake and eating it policy stance is probably not one that's going to be able to last particularly long, as is nor is my voice by the sounds of it.
Yeah, well, you know, cake might be a good description there, because what he's done, when you look at it in the cold light of day after all the headlines that we had to sit through last night, he's just given us a few more crumbs. They've done that all the way along this process. We've always said it's going to be a long, drawn-out process. They're not going to turn around one meeting and surprise us all with a rate hike. It's all about just slowly giving us crumbs to build up those expectations for when they're going to exit easing. They did it with the first YCC move. Remember telling us that it's not monetary policy move. It's to make markets function better. They pretty much did that with the second move. And then we've had people saying, we're getting closer, but not quite there yet on the inflation target or sustainable inflation. So the market's taken it because, this is the main guy. This is the head man who's been completely dovish, completely Karuda-like, if you want to put it that way, throughout this, saying we're going to be continuing to ease. We're not there yet. All the cautious, all the caveats thrown in. But now he's given us a bit of a date on when they might potentially look at least changing negative rates or coming out of negative rates. So in Japan terms, it's very big. For us and for the markets, yeah, it's big. And dollar yen went just sub 146 briefly during the morning's trade in Europe. It's bounced since. But is that a bit of a overreaction? Probably, because at the end of the day, nothing has happened, nothing has changed, but it's just another couple of steps more closer towards that exit door. And they're all about making sure the market is prepared, is aware, so there's no real big reactions. So 200 pips on this, big move for a Sunday night and Monday morning, but context needed as always.
Yeah, absolutely. Certainly woke me up on Sunday night, that's for sure. The other thing I've just thought of is it does the Ministry of Finance a bit of a favour, doesn't it? I mean, we were sat this week going, where's the intervention level? Everyone on the sell side saying it's 150. Well, they're going to be rubbing their hands with glee because, as you said, we're 2-3 big figures lower than we were at the start of last week, which certainly does them a bit of a favour in terms of the nerves that we were starting to see around the speed of the moves in the yen.
Yeah, I've got some thoughts to that, which I'll talk about shortly to do with dollar yen when we get into that. But definitely it's pushed the intervention walls from the door for a little bit longer now.
Yeah, absolutely. Well, the BOJ meeting on the 22nd of September, that just got a hell of a lot more interesting. I might have to actually set an early alarm and get up for that one now, I'm starting to think. Anyway, before we get there, we've got plenty of data coming out. And this week's calendar's just mental, isn't it?
Yeah, we've got all the top tier data coming out, particularly for the US, ahead of the Fed next week. Also, jobs data coming tomorrow morning or Tuesday morning. This will be after this show, before you see this show, so that data will be out. But the big number really is the US CPI. And it's very key data because we've also got retail sales, we've got Michigan, we've got Empire Manufacturing later in the week, so a lot of data coming in. But focus on the CPI. Last month we saw CPI rising to 3.2% from the 3.0% we saw in June. Was expected to go to 3.3%, so it came in a little bit softer. The core lost a pip to 4.7%. Now, the market's pricing another big jump up to 3.6%, 3.7% in CPI, but the core to come down to 4.3%. So a significant dip in the core, but that headline number going up. Now, if high inflation is confirmed, that'll be 2 months on the trot that we've seen increases in CPI, and that's going to be a worry for the Fed. Last week, we spoke about the BOC and how they would handle it with inflation in their monetary policy meeting. We wondered if they would pick the growth side of the argument or inflation as their main focus. They left rates unchanged, but they picked inflation as their main concern, leading to a far more hawkish statement and comments from Macklem after. So another 1 or 2 CPI prints and they'll be hiking again. So the Fed may follow the same path. This data may seal a September hike if it's super hot. If CPI...
Whoa. That's cool, isn't it?
No, I've been saying all along. I think there's more chance of hike from the Fed and the ECB than the market's pricing in at the moment. I think this CPI will push those expectations much closer because... they're expecting the headline to go up, but the core coming down. But if that CPI is much hotter, if it's above expectations and the core doesn't come down as much as they expect, the market's going to be pricing up a hike next week. I'm not saying they're going to jump from whatever it is now, 80, 90% chance of non-hike to a 90% chance of a hike. But the market is definitely going to price it, and you're going to see that in yield, you're going to see that in dollar, and they're going to be ramping up. Maybe they don't hike next week, but if we get a third CPI print the month after, what's that going to do for the Fed? They're now seeing a trend higher in inflation, and we know that the core number lags the headline number. So this core number coming down is probably reflecting, things going on April, May, June, when CPI was coming down quite sharply. If headlines going back up, that core is going to start coming back up as well.
Yeah, I mean, you're right. I think the one thing I would caution about the headline CPI number is there's a lot of moving parts there. I think one is gasoline prices are obviously moving higher, as we've seen. You look at crude, you look at diesel, you look at gasoline, whatever. All the energy complex is starting to rally in a more sustained manner. So that's obviously going to drive inflation higher. The other thing is you've just got to be careful of the base effect, because that is now actually acting as a bit of a boost to the headline number rather than a bit of a drag, as we saw earlier in the year. So if you start to look at the headline number, but the month-on-month print rather than the year-on-year print, I think we're expecting month-on-month at 2-3 tenths, something like that, which actually, when you then start to annualize 3 months worth or 6 months worth, the picture is still not great, but it's a lot less scary. It's showing headline CPI just being stable rather than actually starting to accelerate. So I think it's a concern for the Fed. I think this comes back to what Powell has said before around the lack of progress being made on inflation. But I think you're going to have actually even a disastrously bad print. I really can't see the Fed doing anything other than just a pause next week, wait for the September print next month, and then hike again at the start of November if you have to. But of course, as you say, it won't stop the markets running away with itself. And I think it's now about a 5% chance they hike. So yeah, certainly that would get upgraded if it was hotter than expected.
Yeah, but as I say, I'm not saying they're definitely going to hike next week. I just think the risk is higher than the market's pricing, and this data could, bring the market around to that thinking. But you've got to listen to what the Fed's been telling us, and pretty much every Fed member has been saying the job's not done on inflation. And so if they see evidence that inflation isn't coming down or is remaining sticky, then that's their concern, and that's what they're going to act on, more so than a weakening economy. We've seen inflation rising in Canada, in the Eurozone, a lot of countries over there. And, we'll end up seeing what the UK is going to do next week. And those wages numbers in the jobs report that we're going to get overnight, they're going to be very important too. So it's not just a US thing. It's suddenly a global thing where inflation might start picking up again. And if it does, that's going to scare a lot of Fed members who have been saying that, inflation's been going our way. Politicians, Biden, Sunak, all been saying that, inflation's going as we predicted it would be and as our policies have forecast it to go. And it might not be. And that is going to be a super big worry for central banks.
Very much so. We'll talk more about the Fed next week, I'm sure. But one thing I did just want to bring up is I think we need to watch the dots very, very closely. What is it? 75 bips-ish of easing that's priced in terms of the dots between this year-end 23 and year-end 24. It may be 100 basis points. I can't remember the exact figures. But I think you are probably going to see that 2024 dot revised a little bit higher, I would imagine. Just given the stickiness of inflation, particularly the core number that we've seen so far. And that's something that isn't priced by markets. If you start to look further out, either on the OIS market or if you look at Fed fund futures, which I think everyone can probably get access to from the CME website. So plenty of moving parts into that Fed meeting next week, which is going to be all fun and games as always.
Yeah, and you're right about those dots. That's going to reflect the higher for longer stance of the Fed. So it's going to be very important.
Absolutely. Before we get there, though, we've got some UK data out this week. As Ryan just said, we're going to have the latest employment figures out between me giving this little monologue now and you watching this show. So bear that one in mind. But the jobs data is the obvious focus this week. We've also got July's monthly GDP print due on Wednesday morning, expecting that to show a modest contraction of around 0.2% on a month-on-month basis. If you think back to the July retail sales print, that was pretty grim. Consumer spending fell quite significantly. Everyone blamed the weather because July was a complete washout, and you would expect the same excuse to be trotted out once more if the monthly GDP print misses expectations as well. That is a very lagging indicator, and the PMIs and things like that have already basically told us what happened in the economy at that point. So the jobs data is of much more focus this week. I think it clearly has much greater implications in terms of the BOE policy outlook. Regular earnings set to rise by 8.2% on a year-on-year basis once more. Given that we've had July's inflation data as well, that will put real earnings growth somewhere around 1.5%, 1.6%, obviously depending on where the printers come in by the time you watch this. So that's clearly a concern for policymakers. And we're also set to see unemployment tick higher to 4.3 from 4.2%. So assuming we're somewhere in line with those expectations, that would be signs of a stagflationary jobs market, although there are still obviously a few one-off factors pushing earnings higher, some NHS pay agreements and cost of living bonuses going in, which will come out of the data as we move through the remainder of the summer. I think what's a bit more interesting, though, is that the market did seem to get a bit of a reality check from the BOE last week. We heard from the chief economist, Hugh Pill, who was saying that he favours a table-mounted approach to policy. So to put that in English, basically rates going up to a lower level and staying there rather than a big spike in rates and then a very, very big sudden spike the other way. That is not what markets have been pricing. Obviously, markets have been pricing in a higher terminal rate at around 6% at one point, where we wouldn't reside for particularly long. And then we heard from the Governor, Bank of England Governor Andrew Bailey, at the Treasury Select Committee last week, saying that we're near the top of the cycle on rates. Now, what he meant by that was not we're going to cut rates soon. It was more we're near the peak. We're near the terminal bank rate. So markets have dovishly repriced a little bit, about an 80% chance now of a hike in September. I think terminal is priced around 5.6%. So personally, I see a very, very high bar for the BOE to do any more now than just one more 25 pip hike in September. And I think at that point they're done, which could expose sterling to a little bit of downside risk, particularly if you see the Fed continuing to charge higher and possibly eyeing a hike in November.
Yeah, and he's always been a reluctant hiker. Even in his comments last week, he was saying, "Yep, we may be near the peak, but that doesn't mean we can't hike again." We obviously had Dinger out as well alongside him, saying she was at the top in rates and, probably at the top about 6 months ago. But, they're restrictive enough for her, and doing any more risks hurting the economy further. So we know where the lay of the land lies at the moment. But I think that the hike is probably nailed on, because if you're going to hike, why wait? Get it done now. I'm still maybe thinking that we might get one more. That'll be the very top if we get one more out of that. But I put that probably at about 30% chance sitting here now, that they peak, 5.75%. So probably, 5.5%. That's where we're going to top out, as long as the data plays ball. We get that CPI data from the UK a day before the BOE. So whatever happens now with the jobs numbers and these wage numbers, that could all get upended next week. So it's a case, as it has been this year, or the latter part of this year, trading between the data points, and you've got to take each one as it comes. But yeah, I think one more hike at those guys may be strong signal that they're done, which, in those terms, they've been bitten on the arse by that before. And probably going to see some downside in sterling if that's the case.
Yes, I would expect so. I don't, excuse me, I don't think it's a chart that we've got in the show this week, but sterling is getting quite close to its 200-day moving average at this point. So that is obviously worth bearing in mind. I think that comes in around 124.30 from memory, although obviously traders can bring up their own charts. I just wanted to make a point about Dingra, and I've just been trying to look at this while you've been talking, and I couldn't quite find the spreadsheet that I've got in time. Fair enough. You think we're too restrictive. You think rates are too high. 100% entitled to that view. Diversity of thought in the MPC is a good thing, but
is it?
It is. Sort of, unless your name's Ben Bernanke. The problem I've got is Dingra's been saying this for, a year now? 9 months? Never voted to cut rates. If you think rates are too high, if you think rates are too restrictive, you've got to vote, use it to cut. Because going into every meeting and then going, no, I just favour leaving them where they are, well, there's no point giving us all the rhetoric that you think policy's too restrictive and they're not putting your money where your mouth is. You paid enough, grow a pair. Come on, rant over.
And there ends Michael Moan's number 4,236,863.2.
Yuresh will be pleased. I'm in black shoes, though. He won't be too pleased.
Oh, no, definitely not.
Right, let's talk about our other favourite central banker, Madame Lagarde.
Yeah, Queen Suntan, she steps up on Thursday and, like the Fed and the BOC, goes into a meeting with some of the bigger countries seeing increased inflation and subdued growth. Germany, in particular, still in a big hole right now. So there's very little expectations for a hike this month. Rate probabilities, about 41% chance of that. Recent speakers have been reasonably coy about things. The Doves, like Centino, have said enough is enough, though still added the caveat that a pause and saying that we are done would be the wrong message. One of the hawks, Klaus Knott, said that markets may underestimate a September hike chance. So there's been comments from all sides of the hike pause spectrum. So, it really is a bit of a coin toss, this one. For me, I think they need to see more inflationary pressure to seal the deal for another hike. But I also still think there is a greater chance of a hike this week than the market predicts. The ECB, they are all about inflation, which is why they've lagged in the level of rates, wanting to be sure that inflation was an issue, to now making sure they get it under control. I expect the core message from Lagarde & Co. to be a similar theme to the Bank of Canada, making sure that the job against inflation, or making clear that the job against inflation isn't over, and that they will fight tooth and nail to do what's necessary to get it under control, even at the expense of growth. So lots to come on. They have got a few tools they can mess around with as well if they don't go for a hike, obviously QT and that sort of thing. And a bit of pressure has been coming in on them doing more on that side. So it is all up in the air. Market expectations, again, a little bit low to what I would think they would be. I'd probably have them maybe 60-40 for a hike, but it's going to be another interesting one.
Yeah, it is going to be another interesting one. I'm going to stick my neck out here. I think the ECB are done. I don't think they're going to hike in September, and I think by October feel free, clip this up as much as you want.
I'll have it on video, so I don't need to make notes.
ECB done, nothing in September, nothing in October, because I think there's a few calls on the sell side that they're going to pause in September, this month, this week, and then go again in October. I can't see that. I mean, the PMIs are weakening at a worryingly rapid rate, and there's really no sign of that stopping anytime soon. So if the logic is the ECB are going to not hike and hold rates at 3.75% at this meeting because they're worried about growth, the growth situation is only going to have got worse in 6 weeks' time, because China doesn't look to be getting any better. Germany is really in the doldrums at this point, and if Germany is dragging the entire rest of the Eurozone down with it. So personally, I think those downside risks are only going to accelerate. Of course, we're going into winter as well, and there's a war still going on in Ukraine. So what's going to happen with the geopolitical risk side of things, we just don't know. But I think the ECB, their window to raise rates has now slammed firmly shut. The problem they've got is they can't raise rates anymore, I wouldn't expect, because it's going to hit growth too significantly. But they also haven't got inflation under any sort of control. Core inflation's been above 5% for almost a year now. So the ECB are in a stagflationary bind that I'm not sure Lagarde knows how to get herself out of.
Probably the same way as she gets out of a locked sunbed. But I disagree with you slightly. The growth side is one thing, but inflation's their mandate. Price stability is their mandate. That's what they got to stick at. Because if inflation goes, back up 6-7%, they're going to have to act on that. Whether growth's, cratering, they've got to act on that. They can't not act on that. I think that's what keeps the hawkish bias in the message that we get from them on Thursday.
Yeah, I think they'll be data dependent. I think there'll be a notional tightening bias in there, but I'll just be taking it with a bucket full of salt. I think what really tipped the balance for me was when we heard from Schnabel, who is probably the most hawkish on the exec board, German as well, so very, very influential. And even she was flagging the risk of over tightening, downside risks to the growth outlook. And that for me just kind of solidified that, yeah, they are not going anymore.
Well, I'll see your Schnabel and raise you a nagel, because he's been talking about the inflation problem still as well. So
he has, but he doesn't have a vote.
Well, it's still on the governing council. They all put their input in, and they actually all have to agree what Philip Lane says, because he's the one who writes up the decision.
That is very true, and he's a dove. So,
right, you took your book, mate.
We could go on all day here, but we probably shouldn't, because we've got plenty of charts to get through. So let's move on to That's a Setup. Right, I want to look at the S&P first of all. I'll probably get told off for doing this, but I'm going to anyway. This is not a chart of the S&P this year. What this is a chart of is the average performance of the S&P 500 normalised on a percentage basis over the last 30 years, to try and give a little bit of historical context around what's going on. Now, the first takeaway from this is generally the index goes up and to the right, which helps to explain why I and many other market participants have much more of a tendency to be bullish on equities than bearish, because otherwise you're just fighting the prevailing trend. What's perhaps a little bit more interesting is if you look at where the yellow line is, and that yellow line is today, or yesterday by the time you watch this, but around about now. And what it shows is that we are approaching what over the last 3 decades has been pretty much one of the worst times of the year for the S&P 500. We often see some declines in kind of mid-February, early March. That's tax-related in the United States. And we also often see some declines between mid-September and early October. Now, I would never put a trade on based solely on seasonal trends. I think that's absolute folly to do so. But firstly, the thing you've got to ask is there a reason that can explain the trend? Well, as I said, the move in the early part of the year is often tax related. The move at this part of the year is often a case of everyone coming back after the summer, after Labor Day, and going, what's really going on? Am I happy having the exposure to risk that I do? Are there things out there that I'm not aware of? Do I want to reposition my portfolio? So first tick in the box, there is a logical explanation for it. The second thing is you've got to think, well, this year, in the here and now, what's coming up over the next couple of weeks until early October, when we tend to see things bottom? Well, as we've just discussed, we've got an inflation number out of the US. We've got the next Fed meeting. We've actually got 8 G10 central bank meetings over that time period between now and then. We've also got a jobs report out of the United States. So there's plenty of factors out there from the macro standpoint that could drive price lower, particularly with the balance of risks continuing to tilt hawkish for the Fed. And then you look at the technical side of things. You look at last week's price action. We closed below the 50-day moving average again, and we also closed below 4,500. So I think there's a few stars aligning here, Ryan, for me to just start getting a little bit more cautious on risk. And I wouldn't be entirely surprised if we saw the S&P come 150, 200 points lower. 4,300, 4,350 is kind of a level that I might be looking to step in and buy the dip. But I'm starting to become a little bit more cautious on risk just in the very short term.
Yeah, and I think you may be right. Obviously, we've got these big meetings, central bank meetings, they're going to have an effect on stocks. Your 4,300, if memory serves, is a bit of a decent level on its own. I think it was the break point before we got that first run up back to sort of 46s. So it's going to be a very, very interesting level to look at there. I'm 100% with you on seasonals. I know a lot of people like to look at seasonals, but every year is different. And if sometimes you actually look at the long-term returns of those seasonal numbers that people like to print, it's 0.4% up, 0.5% down. And what I say from seasonals, no one comes in the first of the month, buys or sells an asset and goes away for the next 31 days to see how it's done. So, yeah, you use seasonals in terms of this may be a pressure that has an influence on a particular asset at any one time. But I think, yeah, we've had this move back to 4,500 in the S&P. It hasn't lasted, and we're back down again now, sub 45. So, your chart's potentially coming true, and if that happens, you can claim yourself to be a genius.
Indeed, and even if it doesn't, I'll try and make that claim anyway. Right, go on. I can see we've got War of Peace on dollar yen.
Oh, here we go again with the War and Peace. It's called being detailed, mate. But anyway, yeah, it's apt that we look at dollar yen with everything that's gone on. I must have rewritten this one about 20 times since I started yesterday afternoon, Sunday afternoon. So it was going to be about initially watching for, some perhaps tougher upside to dollar yen after we had Japan's FX man Kanda dropping the speculation line into the jawboning comments. And this was particularly unusual because it took the rhetoric up a couple of steps, a couple of notches more than they usually do. Speculation is usually one of the last or final language steps before intervention. However, now we've had the Bank of Japan head, Ueda, telling us that they could end negative rates. Dollar yen opened up initially down 100 pips, despite a small bounce to 147 just before I went to bed. It collapsed another 100 pips over the Asia session and into UK day. For now, as Michael mentioned, the intervention threat should be lower now. And as we type this, we've traded up again to 147, now back down to 146.35s. When you see this video, we'll either be above 147 or we'll be holding below it. And I think that's the key point to look at here, because there's still plenty of time to see something happen or all the data before we get to Ueda's point where the data might bear fruit for them to change policy. So my analysis is going to sort of have to cover both angles for now, because you're not going to see this until Tuesday. So sub 147, keep a look around that 146.50 area, which has been a constant level over the last few weeks. The market, if it's brushed off the news, then maybe we're going to get back above 147. If that happens, then we could get a proper run on those 147.80 highs. And maybe then we push on to 148. For me, I'm more in a dip buy mode rather than a rally selling mode right now, despite all the news, because there is a lot of time to pass before we get to a point where you either might end negative action. So I think the trend that we saw, dollar bullishness going into last week, I think that remains and should reassert itself over what we've seen from the BOJ thus far. There's enough to deal with, and obviously then we've got big things like US CPI to take into account.
Yeah, definitely. The Ueda stuff's just thrown another kind of spanner in the works when it comes to dollar yen. But I'm with you. I think I don't see this as anything. This isn't a case of Ueda saying we're going to change policy next week when we meet. It's a very caveated, longer term, tiny hint at something that they might think about doing. So yeah, I don't think this is going to deter the bulls from dollar yen too significantly. And as you said, we've obviously seen a little bit of dollar selling creep in today. I wouldn't be surprised, actually, if we did see the buck consolidate just a bit. I mean, as I said in the intro to the show, 8 weeks of gains is a hell of a long way to come in a relatively short space of time. So perhaps a bit of an excuse for some profit to be taken off the table, but medium term, I still see dollar yen rallying up towards 150, and then we're back in the intervention conversation again.
Yeah, I think 150 might be a bit of a push now. I mean, it's, we had Timmy Leaks coming out with a piece over the weekend as well, saying that the Fed
started on it.
The Fed might be done. So I think just at the moment, with that intervention talk that we got that stepped up a couple of notches now with Ueda, with the market now, potentially pricing an unchanged from the Fed. Even if it's just short term, there are just little pieces of evidence to say that the upside, particularly for a pair like dollar yen, might just be a bit more tougher. So, we've got the solid highs up there, 147.80s. That's your level to keep an eye on. If we get back up there and break that, then we're off and running, and you might get your 150s after that. But if we get up there, run into trouble, then we're probably going to see a bit of consolidation. Need to look at that 145 area down below, 144.60s, 80s, because that's going to be the support level to keep an eye on.
Yes, indeed. Right, from one low-yielding safe haven to another, dollar Swiss. I wanted to just bring this up. I had this in as a play of the day a couple of weeks ago, 3 weeks ago maybe, and it seems to be a case of slow and steady, very slow and steady, winning the race slowly but surely. I mean, volatility outside of the yen, of course, remains pretty subdued across G10 FX, and the Swissy is, of course, no exception to that. But if you recall, I was long on a break of the red descending trend line there, on the idea that the Swiss National Bank were going to pivot into a more dovish stance at their meeting in September, which is coming up next Thursday. Since then, we had the August CPI number come in 40 bips under the SNB's target, a little bit firmer than expected at 1.6% year on year, but still, when you think about, the UK's got core inflation at 7%, and the US, we're talking about it at 5%. The fact that Switzerland is at 1.6% is something the Swiss National Bank would be celebrating. And the growth risks that we're seeing in the Eurozone are making their way into Switzerland too. GDP unexpectedly stagnating on a quarter-on-quarter basis in Q2. And you can't really say that the woes the Eurozone are experiencing at the moment aren't bad news for the Swiss economy going into the remainder of the year as well. So all of this just reinforces the original view that I had, really. It's nice to see that we now trade north of the 100-day moving average, and just for the benefit of Blake Morrow, who I know loves these things, we're also north of the 38.2% retracement from the decline that we saw earlier in the year. Be interesting to see if we can hold above both of those levels on a retest. We seem to be doing so for now, but I still like this higher. I still like playing this from the long side, and I think the 90 figure and then maybe the 90, 50, 200-day moving average are starting to come into view at them. Yeah,
very nice play of the day, mate. So congratulations on that one. You nailed that one on the head. A bit better than my gold call last week, which didn't last too long. I'm glad I kept a tight stop loss on that one. But yeah, the S&P, it's a strange one. The inflation still never really took off over there like it did everywhere else. And that was one of their key points, that inflation wasn't going higher. Their meetings are quarterly, so they have to sort of pack in a lot into those meetings. And I think you're right. I think if they do signal that they're on pause, then you're probably going to get a move up to that 90 level, that moving average, and maybe even the 91, which has been a bit of an area going back. But even if they they do hike or they sound a bit hawkish, I still think that's probably a dip you want to be buying and or adding to your longs. If you get down to that pink line, what moving average is that there? 55 or 50 moving average, which is at old 23.6 fib around 87.64. So you get a dip down there, and the trade may still be good again.
Yeah, so the other reason I like this is because there's a couple of divergences. You've always got a rate divergence with the US, but you've also got a big growth divergence as well. So when you're talking about differentials and spreads you can trade in FX, there's a couple for people to get their teeth into on this one as well.
Yeah, and you've also got to remember it is probably the most manipulated currency there is.
That is very true. Right. Oh, we are going to talk about the pound. I hadn't seen that on there. Oh, joy.
Glad to see you did your homework before we started the show, mate, and see what we're doing. But yeah, we're going to talk about cable and a little bit of a lesson, because I had a bit of a stinky trading period last week. So this is another lesson in what happens if you don't follow your own rules. 124.50 has been a significant level going back into late 2022. Don't ask me why. Through April to June period, it seemed like every move ended up with us being back at 124.50. So that was one of the reasons I decided to try and catch the knife there last week when we got the move through 125s. And it's a trade which worked out well until I messed up my trailing stop. And I have a rule, and that's not to park stops right on a level. And the rule is to put them either below for longs or above for shorts, so that you don't get stopped out at a significant level and then that holds and the price goes back your way without you. So in this case, after taking some profits up into 125, for some reason I pulled my stop up from the original 123.80 to 124.59, which was actually break-even point for my average long position. And I did that rather than keeping it below 124.50. So Friday night, I wasn't expecting it, but we fell back. 124.50 got nailed on the head. My trade was stopped. Monday morning, we're trading back into 125. Now, by the time you see this, we would have had that UK jobs report, and that wages number could have added or detracted from the set rate high expectations. If we're below 124.50 significantly, watch for it to become a solid resistance level and cable to take a fresh leg lower, which would put 120 in the frame, and that's going to be a big level all in itself. Any rallies up in cable through 125 could be the last hurrah if the BOE indicate that they're one more and done on rate hikes next week. But on either scenario, I still remain bullish for the pound overall.
Bullish for the pound?
Yeah. Sorry, bearish. Can't read my own writing. And that's even while I'm still long the pound. So don't know what I'm talking about there.
Sorry,
I told you I was having a mare.
One who hasn't done their homework? Bearish on sterling. It's music to my ears. Yes. Exactly what I want to hear. I agree entirely. I think selling rallies in the pound is certainly the way that I would like to be playing things here. I'm still I've got no idea how some of the data is starting to is holding up as well as it is. We're starting to see the PMIs roll over a little bit. I'd expect some of the hard indicators to follow, and I think the pound is going to roll over along with all of that as well. Yeah, well,
a lot of people always bearish the UK, and it does have a way of confounding those calls sometimes and doing better than the markets expect. You've only got to look at that amazing growth revision that we had where suddenly we weren't the worst country to come out of the COVID period. We were actually one of the best, but we can't trade all data. We can't trade all data. We can only trade going forward.
Indeed. The other thing in terms of the pound, just to mention, is obviously sterling's had, 3-4 weeks of losses now. Good news for the FTSE. The FTSE was, I think, the best performing DM equity index last week. Only up 0.2%, but we'll take anything we can get at this point with regards to the London market. So although sterling may be in the doldrums, UK PLC necessarily is not. Right, let's move on to our plays of the day. Well, I can guarantee you we're not both going to be right this week. Right, I am looking at euro dollar. Let me just clarify, we did not confer in advance. This is just, we each came up with our play of the day, and this is how it turned out to be, which did confuse our producer Kyriakos just a little bit when he put all this together. Right, euro dollar. I'm not sure whether this is brave or stupid taking this view before the ECB, but I guess time will tell. I never really like the look of the euro, and I certainly don't like the look of it much at the moment. We've been consolidating for a while between kind of 106.75 and 107.5, but we've had a very chunky decline. I mean, what's that? 5 big figures or so. And the euro just hasn't been able to rally and retrace any of that in any sort of a decent manner. And of course, we remain below all of the key short, medium and longer term moving averages as well. So I'm looking to be short the euro. I'm happy to take that position at market. I think the bar is very, very high for a hawkish surprise from the ECB. And in a similar way to we saw with the Swiss franc, you've got both a rates and a growth divergence between the ECB, who are likely pretty dovish and have dismal growth in the Eurozone, and the Fed, who are retaining a hawkish stance and where the US economy continues to perform well. So I think we will probably see a move towards the 105 level around the end of September, start of October, perhaps. Of course, we've got to break below 106.50 first, but I certainly favour this to the downside. But positioning is getting quite crowded, so I'm not the only euro bear out there, but despite that, I'm happy to take on the view. Ryan, how are you playing things this week?
Yeah, well, I'm sort of on the other side of you. It's one of these things with Forex trading. We can both have opposing opinions. We can actually both make money. My trade is probably a bit more of a smash and grab into the ECB. I'm looking at the long side and mainly that 107, 106.90 support that we've hit and we're holding. The bounces have been pretty weak, but the level is a level until it's not, and it's proving a tough nut. I think it only breaks if we see additional US dollar strength coming in rather than any weakness in the euro. So it could be a level that holds into the ECB. We could also see some shorts reducing position or exposure ahead of the risk event on Thursday. So I'm a bit more hawkish on this meeting as well than the market. So I'm looking at potential longs into that 107 area, run it into the ECB if I've got a bit of decent margin in there. If they do hike and it pops, I'll be jumping out as quick as possible, either all the trade or most of it. And then I'll let you have your turn, mate, and see how generous I am.
Well, there we go. As you say, it takes two to make a market. We will see how both of those trades pan out this time next week, because that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining us. Thank you also to our producer, Kyriakos, for bringing this together as brilliantly as he always does. If you've enjoyed the show, drop a like on the video, leave a comment as well. Let us know how you're trading the markets and whether you're as excited as we are for the central bank meetings coming up over the next couple of weeks. We will be back with another show this time next week. Thanks as always for watching, and goodbye for now.